All right. Today is Monday, July 5th. This is a recap for the stock market activities last week. First, let's hope that everybody had a good 4th of July holiday. The United States of America turned 245 years old. The bad news is that's pretty old. Yet the good news is that America is still younger than Clint Eastwood. For me personally, living here in the great city of San Diego, I was invited to a high-rise condo overlooking the bay to watch the fireworks. And thankfully everything went on as expected. No surprises at all. Because if you might remember, a few years ago, we had this.
This is, we could call this a fireworks fail. Maybe not so if you were watching this. This entire 4th of July fireworks show, boom, exploding all at once. Check it out. Whoa, no way. The beginning, the middle, and the end. This was San Diego, the Big Bay boom, and it kind of went bust.
So while the fireworks this year went on as expected, what did not go on as expected is ride sharing from Uber and Lyft. To my surprise, of course, I've been living in a cave for a little over than a year, and now that I am out and about, I am getting to experience the inflation and shortages firsthand. And that could not be any more evident than the shortage in Uber and Lyft drivers. First, it was hard to find a driver to begin with to get us all the way to downtown. But it was pretty much impossible to find Uber and Lyft drivers getting out of downtown back to the house. A matter of fact, everybody was waiting for Uber and Lyft drivers. We're all looking at our phones and asking each other, "You looking for an Uber driver?" "Yeah." "Well, there's nobody working. I've been waiting on the app for 20 minutes now. And there are no cabbies either. You know, the old school taxis. There was a shortage in that too. And apparently, this is not a phenomena that took place on the 4th of July only. According to the people I asked, this has been going on for weeks and weeks. And now that the economy is reopening and people are going back to bars and restaurants, etc., they're finding it extremely hard to find drivers, and the rates are extremely high. So I immediately knew what was going on, due to the fact that I cover the economy every single day. I put two and two together, and I figured out that we have a shortage in Uber and Lyft drivers. And the truth is, if this shortage continues, it will start to hurt the bottom line of Uber and Lyft. These companies will have to offer more incentives and a bigger cut, perhaps more bonuses, to attract drivers back into the platform. This story is not only Lyft and Uber's story, but it is actually happening across the economy, specifically in travel and leisure, where we're seeing airlines canceling flights all over the place due to staff shortages. And this is adding more fuel to the fire of wage inflation. We know that wage inflation is not transitory. Wage inflation is likely to be permanent. Oh, and by the way, even if you ditched Uber and Lyft and decided to drive your car last weekend, you paid an arm and a leg because gasoline prices reached the highest levels in 7 years. Now combine the evidence that we have so far from the CPI, the PPI, core PCE, the highest numbers in decades. And now we have gasoline prices reaching the highest levels in over 7 years. In addition, we now have wage inflation. The bonds market, the stock market can do whatever they want, but the facts of where the economy is heading are clear. We're seeing higher inflation than usual, higher than expected, and it is morphing into wage inflation, a permanent block of the phenomena. And this is adding pressure on Fed presidents and Fed personalities to start taking inflation more seriously by perhaps starting to talk about tapering and raising interest rates. We are finding more Fed presidents reaching into their pants and realizing that everything is still intact. And they are speaking out, warning and cautioning that perhaps the time for tapering has arrived. We know at least two of those, Dallas Fed President Kaplan and St. Louis Fed President James Bullard. But now we have another one from the Philly Fed. Fed's hawkers support start of bond buying pullback later this year. And he said, "I am in the camp of starting the tapering process." So now we have at least 3 Fed presidents saying that we should start tapering by this year. And here we have another one, not quite as courageous, but still. And this is Boston Fed President Rosengren. He says the U.S. cannot afford housing market boom and bust, and he issued a warning. You don't want to see too much exuberance. So we're seeing more hawkish stance from various Fed presidents, and now it has come to this. The destiny of Fed Chairman Jerome Powell sits on the outcome of inflation. If inflation gets out of hand, the likelihood is that Jay Powell will not get another term as Fed chairman. Not only that, but his legacy will be tainted, and he will be known as the fool who brought back inflation once again after 40 years absence. So for now, this is what we have. Camp 1, the Pumpers, led by Chairman Jerome Powell and his tag team members, Vice President Clarida and New York Fed President Williams. And on the other camp, the defectors, the rebels, we have St. Louis Fed President James Bullard and his tag team members, Dallas Fed President, aka the Chairman. We call him the Chairman because he likes chairs. Bob Kaplan, and the newest addition to the team, Philly Fed President Harker. And we'll be watching what will happen to other Fed presidents, from Rosengren to Evans to Daly to Mr. Boystick. For now, they're following the playbook. But who will start to defect next? If we see more Fed presidents joining Bullard, Kaplan, and Harker, the market is going to start to panic once again because the likelihood of tapering moves a lot sooner than previous expectations. But rest assured, if my FUD scared you, I got some good news for you. Because the FUD, that's scary stuff. You don't do that. You don't scare us. We're sensitive people. When you do FUD, we get scared, we shit our pants, and it's a mess. Stop it with the FUD, bro. Okay, I got good news for you. On Friday, we got the big non-farm payroll report from the BLS. And the U.S. economy added 850,000 jobs in June. That's good news. Oh, wait a minute, I'm sorry. Good news is actually bad news for the stock market? I'm sorry, I wanted to stop it with the FUD and give you some good news, but now I realize that good news is actually bad news for the market. Then why did the market trade higher? Impulsively higher on Friday? Because what is this? What is this? The headline doesn't look like it is complete. It says U.S. economy added 850,000 jobs in June as what? What's going on here? Can we get the full headline, Mike? Mike is my virtual assistant, by the way. And here it is. As unemployment rate ticks higher, unemployment rate rises to 5.9%. Yes, we got some bad news. NASDAQ to the moon, bro. Now, here's the problem. 850,000 jobs, that was described by the media as medium well. And we know that the Biden administration likes its numbers medium. But perhaps they're now moving to medium well just to show that we're not having stagflation. 850, a lot better than 550, but not as good as 1 million. Nonetheless, it's a huge number when you pin it to pre-pandemic numbers. Creating 850,000 jobs is yet another proof that we're seeing an economic recovery underway, fueled by a lot of cocaine, and this cocaine is causing higher and higher inflation every single day. The story has not changed, but the market, the bond market specifically, remains extremely aloof to what's going on with the real economy. And this is prompting the stock market to react to what's going on in the bonds market. And when we have news such as the U.S. economy creating 850,000 jobs in 1 month, and the 10-year yield actually goes down, the algos will blast the stock market across the spectrum, but specifically the NASDAQ. These are the stocks that do well when rates go down. Does it make sense? Very confusing market action, but for now, the bond market, algos, and the technicals are sitting in the driver's seat. So our concentration at the moment should be 100% toward the technicals, which is coming out in just a little bit, because this will be a shorter video just covering the charts, because I have been working on 3 videos. This is one of them, but I have 2 of those coming out. I've been working on them throughout the weekend, and we will talk about that during the conclusion of this video. But for now, we're moving on to the technical analysis, starting with the SPY 30 minutes chart. What else? We are in this low volume gap higher day after day overnight. The action happens overnight. The market opens higher and builds on the gains. It is trading above the last resistance level of 425.45. Well above that level. For now, as we talked before, the sky is the limit for this chart until and unless the chart gives us the next resistance level via a reversal signal. That did not happen yet. A reversal signal from a 30 minutes perspective, from a daily perspective, it doesn't matter. What reversal signals are we looking for? We have a reverse hammer on a daily chart. We have a gap and crack, a gap down with an increase in volume. All of these are signals for reversals. We don't have any of that yet. Keyword yet. What about the daily chart for the continuous contract for the SPY, the S&P 500? Notice that the volume is coming back to the market, but it is coming back to the upside. It is coming back fueling a market rally. For now, that makes the SPY an extreme, strong, bullish trend until and unless we get the reversal. The sky is the limit for this chart. The MACD indicator is strengthening higher and it still has plenty of room to go. The RSI is in positive divergence. It is a little extended in what it's called the overbought territory, but that doesn't mean a buy or a sell signal until it gets extreme. For now, it is barely trading above 70 on the RSI, which is the level that technical analysts say a certain chart is quote-unquote overbought. But what it tells us is that the best of the gains are getting behind us. The majority of the juice has been extracted, and we are reaching a point where you should be booking gains, not being the Johnny-come-lately hopping on the trade, trying to capture the last bit of juice. Instead, at this point, longs start to trim some profits, taking chips off the table. Meanwhile, shorts, aka bears, they watch to spot the reversal signal. And once a solid reversal signal is clear, they start to short this chart. Of course, not all bears are born alike. Some have more risk tolerance than others, and they start bidding at this point against the market, aka timing the market, which is, in my opinion, not a good strategy, because when the reversal happens, there will be plenty of meat for the shorts to feast on. You don't have to be the first one to arrive at the feast. If you happen to do so, good for you, but it is pretty much depending on luck. And in this business, if you rely less on luck and more on the facts, you'll save yourself a lot of headaches. Moving on to the Qs 30 minutes chart. Similar to the SPY, a gap higher, and we are building on that momentum. Low volume, and the market keeps grinding higher and higher and higher and gapping overnight, trading well above the last resistance, now support level of 344.5. Until and unless the chart gives us the next resistance level, we have no clue. And the assumption that is, that the chart will continue to grind higher. The problem is with the Nasdaq is that it is reaching a topping formation that we have seen back in August of last year. This is a daily chart, the continuous contract for the Qs, the Nasdaq. The volume is still diverging lower. We're starting to pick back the rhythm in volume, but it is picking up higher on the days the Nasdaq trades down. So that is warning signal number 1. Warning signal number 2 is the momentum indicators, the MACD and the RSI, are more extended than those of the SPY, meaning that this one is closer to the end of the juice than the S&P 500. But that alone cannot give you a signal to buy, sell, short, buy puts, buy calls. That is just telling you that there is a reversal imminent, regardless of how impulsive the market might rally right now, because this could be yet another quote-unquote last hurrah rally, the likes that we have seen last August. Old viewers of this channel remember what I said about the trend of last summer and how the divergence became extreme, and that is always a sign the trend is about to end. And indeed, we saw a massive reversal in September for the NASDAQ, and that was the top right there for months to come. And it was the top for the big NASDAQ names like Apple, Amazon, Netflix, and some of these names haven't surpassed those September highs. It's almost a year, and those highs are still holding, at least for now. And when we look at this trend that we're in right now, it started back during the November election of Joe Biden. The market entirely, but in this case the NASDAQ, started to rally impulsively. The normal divergence in this trend ranges from 10% to 15.5%. Right now, today, the triple Qs is diverging by about 10% from the trend line, which means that we are at the lower end of the range, which means that the Qs could rally a little further, but not for too long, because we're reaching the end of the leg higher and the start of the pullback to the trend line. And by the way, this trend line correlates with the 150 days moving average, and some technical analysts are saying that we should see a retracement back to the 150 days moving average. This is exactly what I'm calling for here. I use trend lines instead of moving averages. And this is the trend from the summer of 2020, a very strong leg. We saw extended readings, historically extended readings, in the RSI, the MACD, and I called it the last hurrah rally. And indeed it was, because the highs remained the top for months to come in the NASDAQ. And the question is, are we seeing a similar pattern here? A massive, impulsive, almost vertical rally higher on low volume, guided by options for the most part? Is this yet another last hurrah rally and we will see another top in the NASDAQ? This is my bet, but we don't have a reversal signal yet. So conservative traders like myself, we like to wait for a signal first before initiating a trade. For now, we don't have that signal yet, but we're looking for it. You can feel it, you can smell it. And the more impulsive the chart goes higher, the closer we get to the top. This is what these donkeys, the Robin Hoodiots and the likes, don't understand. They say, bro, you're saying you're smelling a top is near. But the NASDAQ rallied 1% in a single day on Friday. Exactly. These impulsive vertical rallies higher are signs for tops. Watch. What about the IWM 30 minutes chart? The reconstitution is over. We saw a sell-off in the IWM, but I believe that the reshuffling effect is over. And now the IWM, the new IWM, has to stand on its own feet. The problem is it has chicken feet, chicken legs, and that is due to meme stocks. The valuations of meme stocks are extremely distorted. Some companies with inflated values were added to the IWM. Some companies with inflated values, aka GameStop, got included in the Russell 1000, the big one, the big cap Russell 1000. Can you believe it? This is the la-la land that we're living in. That makes the IWM as a liability, because the moment AMC crashes, taking down all of these meme stocks, at least 5 to 10% of the IWM will be trading to the downside. We talked about 233. We saw a double bottom formation. That should have been good enough to take the chart all the way to 233. But during the last video, I said this. I said, watch out for a reversal before accomplishing the 233 task. That will be an ominous bearish signal that will send the IWM at least all the way down to retest 229. This is exactly what we saw on Friday. The chart is now struggling to keep the support of 229. The likelihood is that it will break the 229 support, perhaps going all the way down the support of 223. But for now, we're watching with a big bag of popcorn how 229 will hold. What about the Dixie, the dollar index? We saw somewhat of a reversal signal, a short-term reversal signal on Friday, but that's not good enough to change the trajectory, at least for now, for the US dollar. It looks as if the US dollar is eyeing 93. So far, it has the strength, the momentum to go all the way and accomplish 93. So as we talked with the IWM, if the Dixie fails to reach 93 and breaks 92, the support level for now, that will be a signal that the US dollar indeed topped, and we will see a reversal in the momentum indicators, the MACD, the RSI. They will all top and turn negative. And when that happens, we will have a confirmation of a reversal in the US dollar. And that will be good for what? Good for your boy, In the last video, I discussed the resilience of gold, that while the US dollar continued to pump higher, impulsively so, gold held that Fibonacci retracement level of 1,760. And to me, that was a signal that gold is calling the bluff of the US dollar. Gold is saying, I don't think this guy has a lot more juice to go. And I'm going to stop right here at 1,760 and I'm ready to go higher again. And we're seeing a curling higher upward for both the RSI and the MACD indicators, signaling that the momentum is strengthening for GOLD. The way I see it for now, gold solidified the support level. It should be good enough for gold to go all the way higher to 1,850 once again, and that will coincide with the top in the US dollar. The US dollar will perhaps fail to reach 93 and will start turn downward from that point on. And if that happens, by the way, it wouldn't be just good for gold. It would also be good for commodities, copper, lumber, corn. They all will start rising higher again. And if we see another rally in commodities, will that spark the inflationary fears back into the market that perhaps this whole transitory bullshit is indeed bullshit? This is what I'm watching for. We're seeing lumber looking for a bottom. We're seeing corn already bottoming. Copper, similar story. They're all waiting for the US dollar to start reversing to the downside. And we will see another spark and another rally in commodities, and that will not be good for the bond market. The bond market will not be able to deny another leg higher in commodities. Speaking of the bond market, here it is, the 10-year yield. This is a 4-hour chart. We have a descending trend line, and the chart has been struggling over and over and over again to break above this descending line. The question is, are we seeing a saucer bottoming formation, signaling that the downward trend is coming to an end and we will see yields blasting higher again? For that assumption to hold, yields have to hold the last bottom, which was around 1.35%. So long as the chart is trading above that number, then we are indeed seeing the saucer bottoming and yields should start to recover as we head closer to the third quarter. Now, here is a weekly chart of the TLT. The TLT, which is pretty much the inverse of yields. TLT tracks bond prices. When bond prices go higher, yields go down. We saw the higher low. That was a bullish signal for the TLT. Then we saw the positive divergence in the momentum indicators, the RSI, the MACD, signaling that the TLT is about to go higher. And that keeps the debate alive. Is the bond market really ignoring all of these numbers that you and I are seeing all over the place? The CPI, the PPI, Core PCE, Chicago PMI, Manufacturing PMI, Philly Manufacturing Index, the Empire Manufacturing Index. And now we have the jobs report indicating that the economy created about 850,000 jobs. How come the bond market doesn't see any of that? And it is actually trading as if the risk is for deflation, not inflation. Aside from the Fed's manipulation, aka accommodation, the bond market is also playing the technicals. And the question is, what happens after all the technicals have been played out? In this case, looking at the TLT weekly picture, the momentum indicators are very strong, indicating that the TLT could go even higher, all the way to 149, even 150. But what happens after that? Does the TLT continues to go higher, or is that all there is? In the oversold bounce, and we go back into pushing yields higher and the TLT down, well, the data will dictate all of that. But for now, we know that this is extremely peculiar, that the bonds market is weighing in the technicals, and it's giving the technicals more weight than the actual facts coming out from macroeconomics data. What about the VIX? What's going on here? This is a 4-hour chart, by the way, and we've been tracking this chart for a little while. We're looking at the MACD indicator. In the previous last times, every time the MACD indicator turned green, we saw a rally in the VIX, anywhere from 21% to about 38%. This time around, as the MACD turned positive, it was a lot weaker than the last three reactions. The pop in the VIX was about 13%, bottom to top. And then we saw the MACD turning negative once again. For now, the VIX has a triple bottom. It has to climb above 15. The MACD indicator is not finished going higher yet. The pop we saw could be the appetizer for the real pop, the main course that's about to happen. You see, many analysts looking at the number 14, 15 on the VIX will translate this as a green light for a market rally, because the volatility index, aka the fear index, is is reading at historic lows, meaning that the appetite for de-risking insurance is pretty much getting non-existent. Other analysts, on the other hand, like myself, we view this as a sign of complacency. Complacency might lead to impulsive, insane market gains, but it always signals a top. It always signals a nasty reversal that's about to happen, and that top from the reversal stays for at least a few months to come. Remember, last year, the VIX reached the reading of 21, which was a low, a post-pandemic low at the time. And everybody saw that as a sign that the worst is behind us, and this is a green light for the market to rally. And indeed it did for a few days, and that was the August-September top. And from that point on, the market traded sideways all the way till the elections. Matter of fact, certain names like Apple, Amazon, Netflix, and many other stocks have been trading sideways since the August-September top of last year. And speaking of the IMOB, here it is, Apple 30 minutes chart. Remember, as Apple goes, so will the Nasdaq. And we had these days where the Nasdaq is trading down, but Apple is trading higher. Always trust where Apple is going. The Nasdaq will follow the direction paved by Apple. We saw the gap and crap reversal back around the level of 134, 135. Using that signal and the negative divergence on momentum indicators, I believe that Apple is heading back to 131 to retest support. And I put my money where my mouth is, and I did buy put options. The problem is, immediately the stock popped higher and started consolidating just below 135. I made a video at that time and I said, you know what? I am abandoning this trade because the thesis has gone down the toilet. And now what do you know? Apple traded all the way to almost 140 at this point. So holding on that trade was definitely the wrong decision. Closing it, just like I did, was indeed the correct call. This should be a lesson for every options trader. When the facts of your entry thesis change, you have to change. And in this case, closing the trade and moving on to the next one, rather than being emotionally attached to one trade, betting more and more, and hoping that it will work someday. Until expiration, of course, and then you realize that you lost your money. And therefore, always follow the discipline. In this case, the chart we're looking at right now, it is trading above 138, which is the last resistance level before the all-time highs around 144. The assumption is that Apple will continue to ride higher all the way until we spot a reversal signal. If the reversal happens in Apple before it happens in the Nasdaq, this will be a leading indicator that the Nasdaq will follow through and it will reverse following Apple. What about Tesla? Our favorite, the souffle. Look at that, 679. Show me another YouTuber, another analyst who emphasized and highlighted the importance of 679. This is how you know you're listening to the best. Because a lot of technical analysts actually avoid the souffle's chart because the chart is extremely difficult to read and make predictions on. And therefore, lots of analysts avoid talking about Tesla's charts altogether because they're afraid of looking like fools if they make a call and the chart does the opposite, because it is a chart that has defied the laws of charting, but not for this guy you're listening to. Matter of fact, I gave you the top for Tesla. Those old viewers, the boomers. You remember earlier in the year, and I'm highlighting the RSI level, by the way. I gave you the number of 84. Once the chart reaches 84 in the RSI, that's the top, and indeed it was. Now I'm highlighting 679, and you're seeing the chart respecting the number. The assumption is that this is a bull flag consolidation. The momentum indicators, the RSI and MACD, all still have plenty of room to go higher, meaning that the souffle is not done popping higher yet. You need some sort of a catalyst to throw cold water on this formation. And it has to be in the form of really, really bad news, because regardless of the fires, the weak production numbers, that doesn't matter. For now, the souffle is trading based on the technicals and the options market. And this is a bullish formation that should take us all the way at least to 720. What about A-planned, AMC? The bad news is that the 52 support level has been broken. The good news is that the gap around 50 was filled and the chart reversed higher. Matter of fact, closing at the penny to 52. So on one hand, you're seeing bearish bets, at least via the options market, buying put options against AMC, whether it is coming from Iceberg Research or whoever shorting AMC. On the other hand, you have the apes who are pretty much fully invested. They don't have any ammo to fight back. They need to recruit more apes, attract more money to be poured in buying the stock. Failure to do so eventually will crack this whole rally, and the so-called shortage and the hedges will end up winning. But for now, the apes had enough ammo to fight back and defend 52. For now, this behavior signals some resilience in this rally, that perhaps it is not over because they managed to defend 52. We'll see what happens as more shorts and more hedges start to pile in, buying put options, shorting the stock, and it's about to become a battlefield once again between the apes and the hedges, or shall we say the hedges versus the hedges. Lastly, what about tulips? BTC, what's going on here? Once again, show me these cryptomaniacs, the laser beams, pumps, and the likes. Do any of them talk technicals about BTC at all? Do any of them talk about 35,750? Of course not, because to them, you buy the scam, it goes to the moon, and that's the promise. But they don't give you any information regarding how to trade this technically on short-term basis, medium-term basis, no knowledge at all. I give you the knowledge right here, 35,750, and you're seeing the chart struggling to break above this number. The good news is it is forming higher lows in consolidating underneath 35,750. What does that say? It says that the likelihood is BTC will be able to crack above the number, and doing so will be a bullish signal for BTC that it is about to rally all the way to the resistance level of 42,000. There you go. Laser beams. You happy now? No FUD. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have Italy versus Spain. I know. What are you talking about, Italy versus Spain? Well, this is the economic calendar because nobody will be watching the economic calendar. Nobody will be watching the stock market tomorrow. You guys will be watching this game. So let's be honest, because this will be a positive factor for the market. Low volume, the path under low volume is higher. The path of least resistance is higher when you have lower volume because half of the planet is watching a game. And my call here is that Italy will defeat Spain, and then England will defeat Denmark, and then the final will be between England and Italy, and England will win the championship. This is my call. If I get it wrong, it's okay. I'll stick to financial markets. I'll just abandon my dreams of becoming a sports analyst. But here it is, the economic calendar. We don't have a lot of important events this week. We have the services PMI, and this will come out in the morning. And then Wednesday, we have jobs openings. This will be important to pin the latest number that we got, 850,000 jobs versus jobs openings. If jobs openings continue to go higher, then even the 850,000 number will not look impressive, and that will spark the debate once again for wage inflation. Wednesday, July 7th, we also have the FOMC minutes, and unless there is a surprise there, we already got everything we need from the Fed. The Fed is either hawkish or dovish, depending on what the market wants. They'll do whatever the markets want them to be. Doves, birds, owls, doesn't matter. Stock market, you tell us what animal you want us to be, and we're here to perform. And then Thursday, we have the per usual initial jobless claims. And on Friday, we have wholesale inventories. So as you can see, boring week, no action whatsoever. And therefore, the assumption is that under low volume and no catalyst to spark a reversal in the stock market, the assumption is that the market should go higher. Doing anything other than that will be extremely bearish for the market because you have the perfect environment for the stock market to rally higher, unless the algos decide to look at the technicals and decide that perhaps the market is flashing sell signals, whether it is the Nasdaq, the VIX, sparking a sell-off. If we do see a sell-off, it will be 100% algorithmically triggered. Now, the last thing I want to share with you is videos I have been working on throughout the weekend. One of these videos should be out by tomorrow evening. In the video, we will discuss the housing bubble in particular, and warnings from economists and famed investors regarding the conditions of the housing market. Because this is one market that has reached comical levels. Every time you think it's crazy, it gets even crazier. And now we have people calling that this is not a bubble, there is no need for concern, yada, yada, yada. So we're going to look back at similar calls before the financial and the housing crisis of 2007, 2008. Until then, this is all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.